Hey guys, and welcome to Invest with Will West. Today we are having a Reddit story time. Do you think that you can be a hotshot trader and time the market? Well, this guy tried. Today we will look at a real case study what happens when a beginner investor becomes overconfident and tries timing the market, which ends up losing him 25% of his entire savings. We will also examine what exactly went wrong, so hopefully you won't make the same mistakes if you do consider becoming a trader. Here's what user Troflecopter has to say about his recent trading attempts. After a long time of very responsibly trading blue chip stocks for modest, single-digit gains, last week I started contriving a plan to get into oil and to hit it big. Okay, so my first comment here. From the way he types, I can immediately tell this person is having a rather emotional and vague approach to investing. Modest single-digit gains doesn't really say much. Did he beat the market? On what period? By how much? And with what consistency? Even the language "hit it big" seems emotional and somewhat reminiscent to the rush that a gambler would feel every time the slot machine bell rings. I spent at least 40 hours considering all possible options. Then on Monday afternoon it became clear to me, it was time to strike. I put 50% of my money in. Whoa, 50% of your money on a single trade. Come on, we have to apply some money management here. The stock market should not be a roulette table at the casino. If you want to play the trader's game, the rule of thumb would be to not risk more than 1% of your portfolio on a single trade. And that doesn't mean that with $30,000 trading account you can buy only $300 worth of stock. No. Implementing the 1% risk rule means you take the risk management steps so that you prevent losses more than 1% of any single trade. Let's continue. Tuesday was not fun. Here's what I learned. Don't ever buy into something you don't fully understand. On Monday, I bought into USO as oil prices bottomed, thinking I was buying into a fund that was purchasing up all the May futures contracts. I thought USO was rolling out of April and into May, and were conveniently buying up all the world's WTI at the bottom of the barrel pricing. I saw the warnings all over the place that people didn't understand that USO was based on futures, not spot prices. I knew USO was buying futures, not spot. I thought that meant I understood the warnings. I didn't know that the real risk was that I didn't know which months I was buying into. The funny truth is that they weren't even making most of the moves on Monday. I was way off. To comment on this, in this case I agree that buying something you don't fully understand, that's solid advice. It is one of the basic tenets of investing. Always understand what you are investing in. Even Warren Buffett and pretty much all the big shots confirm this as well. Let's continue. Don't trust third-party sources on the details, not even your bank. Both Yahoo Finance and my bank, RBC Direct Investing, have incorrect information on USO and most major ETFs. For as long as I've been looking, 2 weeks, they said that USO is holding April WTI futures. This is 100% false. I thought that meant that USO had to sell all those contracts and move into May contracts on Monday. I thought USO was being paid to take a bunch of oil that they would then have all month to get rid of, but that's not how it works. Now, I can't claim for accuracy of information regarding USO listing on Yahoo Finance or RBC Direct Investing. If you know if this claim is accurate or not, please let me know in the comments. Let's read on. The word ETF is used extremely loosely. An ETF like SPY or ZQQ2 is absolutely nothing like all the ETFs out there that are attempting to track daily movements of blank. An ETF is just a fund. Don't buy into ETFs that you do not fully understand. Read the actual prospectus. Okay, in this case the term ETF is not really loose or anything like the user claims. It does exactly what it says. The ETF provides exposure to oil futures, not oil spot price. Looks like the author simply misunderstood what an ETF actually is. ETF is simply a legal structure to hold securities. Nothing about that inherently implies tracking of the spot price. Let's read on. Do not underestimate the number of stupid investors out there. As I watched WTI plummet in real time, I immediately saw USO skyrocketing. I thought for sure that meant that smart institutional money was piling into USO. I thought there was no way that retail investors could move 2.5 billion funds that fast, but they were. That was not smart money causing the pump, it was million idiots like me. And here I can just say that if you don't think that markets can get absurd, I just want to remind you that during the real estate bubble in Japan in the early 90s, grounds under Tokyo's Imperial Palace were worth more than the entire state of California. Let's read on. Don't mess around with leveraged ETFs. In addition to USO, I purchased 2x leveraged WTI tracking ETF HOU2 at the very end of the day on Monday. I thought for sure that on Tuesday morning the oil prices would bounce back from the negative and give me a big bump. I figured out even if it didn't work out, I could hold on to it forever until oil comes back. Wrong! You can't hold on to these things forever. They trend towards zero mathematically. If you can't make gains in your first couple of days or weeks, you are probably stuck with taking a loss. You shouldn't even hold these things for more than a single trading day, especially in this crazy market. And here again, simple mistake of not knowing what he was buying and how that asset behaved. I would also recommend staying away from leveraged ETFs. There are a lot of hidden risks that come with them. For one, due to daily rebalancing, in a 2-day period the unleveraged ETF return can be minus 1%, while the 2 times leveraged ETF return is minus 4%. So leveraged ETFs are a great way to increase risk in your portfolio without adding much gain. Despite your father's advice, you can't just be patient and hold on to everything. HOU2, which I purchased into, is beyond toast. The company has all but told investors it's time to cash out. After the fund lost 40% of its value on Tuesday, they froze it and then released official press release that the ETF was worth about 1/6 of its already obliterated market price. They then said pretty clearly that they no longer expected to be able to achieve the fund's objectives. After a few cuss words, I basically kissed my money goodbye. Then, much to my pleasant surprise, on Wednesday morning I saw that it was back up for a trade. Somehow it was rising. This goes back to not understanding the power of stupid money. I cashed out immediately and was very pleased to get 2/3 of my money back. Everyone around me was telling me to be patient and not take a loss. The fund has done nothing but post double-digit losses since then, yet millions of people are continuing to trade it, when they should instead be cutting their losses. While June futures are up 70% since Tuesday, this 2x ETF is down like 50%, yet people still cling on. My comment would be that in this case the father's advice is very context dependent. Waiting for positions to recover instead of cutting the losers with stop loss is a very common beginner trader's mistake. For a long-term investor, however, father's advice is quite applicable. If you apply the same logic to long-term index fund investments, mathematically it works out in your favor over a long time to hold through the declines. Remember guys, time in the market trumps timing the market. Let's read on. The biggest lesson in these oil ETFs is that nothing is certain in this crazy market. A ton of the pain that I felt this week was caused by USO and other funds like them restructuring. USO has been rolling front months futures on a predictable calendar for 12 years. On Tuesday morning they absolutely messed up my investment in USO and probably contributed to the obliteration of HOU2 by surprising all of us with the restructuring announcement. I never in my life thought that USO was going to restructure. I thought the whole point of it was that they were legally obliged to follow a certain predictable futures trading pattern and that certainty gave people a mechanism to buy and sell. Nope. They can legally just do whatever the hell they want, costing retail investors like me an arm and a leg, while their fund managers continue to make 7-figure salaries. It's true, nothing is ever fully certain in these markets, except the fees and the taxes of course, and the manager's salaries. This is why one should always understand rules of sound money management if you are dealing with bets of any kind, be it stock investing, horse betting, or even poker. But that's not really a topic for a beginner investor. Let's read on. Last but certainly not least, this week should be a lesson for all of us that there are mammoth-sized financial incongruities hidden in every corner of the global economy right now. The insanity that has taken place in the oil industry this week should be a warning bell to us all. And speaking of bells, if you are watching this on YouTube, don't forget to click the subscribe button and the bell to get notified of any useful future videos. The 2008 crisis was caused by bad assets in a single industry, considering the demand for everything is down by at least 30% and that the governments have propped up the world with free cash equivalent to over 10% of global GDP. It is quite certain that there are subprime mortgage-backed security equivalent death traps forming in every single industry. It's only a matter of time before more of them pop up. They could appear on Monday, they could appear in August, but anyone who is paying attention is fairly certain that they are out there. Be careful. Well, first of all, are these incongruencies really a surprise to anyone? It wouldn't be the first time. And secondly, never attempt to blame a failed trade on a rigged market or a corrupt system. Instead, see what you could have done differently as a trader in regards to your money management. If you do decide to trade, your trading system and money management should be set up in a way to favor asset preservation overall. And there you have it, the story of how to vaporize 25% in a few trades. And 25% is not really that much when you think about it. During these unstable times, people have lost much more. I would consider that our friend Troflecopter has actually gotten off pretty easy here, and also learned a valuable lesson in the process. Let's thank him for sharing this lesson with all of us so we can avoid these mistakes in the future. Thank you for watching and stay safe, investors. This has been Reddit Storytime with Will West.